Good morning. Welcome to Top of the Morning by Mint, your weekday newscast that brings you major stories from the world of business. It's Friday, April 25th, 2025. This is Nelson John. Let's get started. A day after India suspended the Indus Waters Treaty in response to the deadly Pahalgam terror attack that killed 26 civilians, Pakistan has called this move an act of war. Pakistan Prime Minister Shehbaz Sharif chaired an emergency meeting on Thursday, rolling out a set of retaliatory measures, suspending all trade with India, expelling Indian diplomats, and closing the airspace to Indian-operated airlines. The 1972 Shimla Agreement has also been put in abeyance. Now, can Pakistan really afford a war? Its economy says no. Islamabad's economic reality makes an escalation deeply risky. As of early March, Pakistan's foreign exchange reserves had plunged to just $11.09 billion after a sharp $152 million drop in a single week, mostly due to external debt repayments. Now, that's barely enough to cover 2 months of import. The country's external debt has swelled to $131.1 billion, and it's only getting worse. Officials from Pakistan's finance ministry revealed that $100 billion need to be repaid over the next 4 years. For an economy that's already strained, that's a staggering burden. To stay afloat, Pakistan is relying heavily on IMF bailout, a $7 billion package secured in September 2024. But even that lifeline comes with strings attached. The IMF warned of formidable vulnerabilities and has been dispersing the funds slowly in 37 installments. This dependence leaves little room for fiscal maneuvering. Adding to the pressure, US foreign aid via the US aid has been suspended early since 2025, with no word on when or if it might resume. That's one less buffer for a deeply fragile economy already teetering on the edge. Add to the mix, there's the political uncertainty, another layer clouding Pakistan's already fragile governance. With no prime minister in Pakistan's history ever completing a full term, political instability is a constant. The ousting of Imran Khan's mid-term is the latest chapter in a long saga of internal turbulence. While Islamabad's rhetoric is heating up, its capacity for confrontation may be far more limited than its declarations suggest. Quote-unquote, responding with full force across the complete spectrum of national power. As promised by Pakistan's PMO, may be more of a political statement than an actionable strategy. With India holding the upper hand diplomatically, economically, and militarily, and with Pakistan facing ballooning debt, falling reserves, and political churn, experts say a full-blown escalation could backfire, plunging Pakistan into a deeper economic crisis. As US markets wobble under the weight of Trump's tariff war, Indian retail investors are looking elsewhere. Platforms offering global investing access say there's been a clear shift in investor appetite from the US to emerging markets like China and Brazil. Since February, we've seen a rising interest in China-oriented ETFs and select Chinese companies. The trend is shifting, said Sitar Shrivastava, CEO of Borderless. This trend is echoed by brokers across the board. Zinc Money reports growing demand for China tech, energy, and EV ETFs, while Brazil is catching eyes with its attractive valuations and macro tailwinds. There's a rotation out of crowded US trades, says Viram Shah of Vested Finance. People are looking at under-owned markets like China and Brazil, where the upside hasn't been fully priced in yet. Brazil in particular is drawing interest on hopes of rate cuts, a recovery in growth, and insulation from global tariff shocks. Despite tensions with the US, analysts believe China's domestic-focused economy and growing alignment with the EU offer long-term resilience. A diversification becomes the new buzzword. It looks like Indian investors are already exploring beyond Wall Street. Pakistan on Thursday closed its airspace to all Indian-owned and operated airlines. The no time issued by Pakistan also applies to military flights. Flights will now likely reroute over the UAE or Iran, adding at least another hour to flying time, a senior aviation executive told Mint. Affected routes include flights to the US, UK, Europe, and the Middle East. In response, Air India and Indigo have alerted passengers and offered rebooking or refunds for affected routes. Experts warn of a surge in ticket prices. Expect fares to rise by 35 to 40% due to the higher fuel burn and longer routes, said aviation analyst Mark D. Martin. Sanjay Lazar of Avialaz Consultants called the move expected but inconvenient, especially for long-haul flyers. The Indian government has also suspended all visa services for Pakistani nationals. While ICAO guidelines permit airspace restrictions for security reasons, they recommend bilateral coordination, something that's now unlikely. With added costs, delays and diplomatic frostbite, travelers and airlines alike brace for turbulent times ahead. India is considering a complete halt to trade with Pakistan. Officials say the move could choke Pakistan's access to key imports like pharmaceuticals, fruits, sugar, and chemicals, many of which currently reach via third countries like the UAE. Trade is already minimal, but this would cut off even essential supplies, said Ajay Sahay, head of FIEO. India's exports to Pakistan surged to $1.21 billion in 2024, up 127% from the previous year. Pharma exports alone stood at $208 million, but experts believe these may continue for humanitarian reasons. Pakistan, in retaliation, has suspended bilateral agreements and shut its airspace to Indian carriers. The diplomatic standoff is also affecting healthcare. Hospitals in India are rushing to treat Pakistani patients before the May 1st deadline. 2 children undergoing heart surgery at Asian Hospital have been given a temporary stay. Doctors say further restrictions could impact critical medical cases, especially among children needing life-saving treatments. Bharti Airtel may be looking to swap dues for shares. The telecom giant has reportedly asked the Department of Telecommunications (DOT) to convert its 40,000 crore rupees adjusted to gross revenue (AGR) dues into equity, potentially giving the government a 3.5% stake in the company. Airtel owes the government nearly 92,000 crore rupees in total dues, 52,000 crore rupees for spectrum and 40,000 crore rupees as AGR liabilities. Under the 2021 telecom relief package, companies were allowed to convert deferred AGR dues into equity, but not spectrum payments. Airtel has already prepaid 66,665 crore rupees in spectrum liabilities, making it eligible for the AGR to equity route. The move mirrors the Vodafone Idea deal, where the government converted 36,950 crore rupees of dues into equity, securing a 49% stake. If approved, Airtel could save big on interest and annual payments, while the government could earn a premium if Airtel stock continues to rise. After racing ahead in early FY25, Maruti Suzuki may now be shifting into the slow lane. The car maker is expected to report muted January-March earnings today, with revenue growth of just 7% and profits likely to dip by 4%, according to broker estimates. Margins are under pressure. Higher discounts and ad spends are dragging down profitability, said Axis Securities, adding that EBITDA margins may shrink 44 basis points year-on-year. While Maruti sold over 6 lakh vehicles in Q4, domestic sales slowed in March. Inventories have ballooned, rising from 9 days in January to over 40 days now, forcing the company to cut wholesale dispatches. Investors are keenly watching for demand recovery, outlook amid tax reliefs and rate cuts, export plans as Trump tariff shakes up global auto strategies, and updates on the company's much-anticipated e-Vitara EV launch, which analysts say is off to a lukewarm start. Despite these hurdles, Maruti's stock is up 6% in 2025, outperforming Nifty Auto. But the road ahead is bumpy. All eyes are on today's earnings call for cues on whether the car maker can regain momentum. That's all for today. Thank you for joining in. We are eagerly looking forward to our next Top of the Morning episode that will be packed with the latest in business news. Until then, this is Nelson John signing off. Have a fabulous Friday.